Good morning, everyone. Welcome to this session on learning from others, incorporating sustainability issues into financial analysis. I'm Michal, Bartek. I lead the listed equity work streams at the PRI. So my role is to produce various tools and guides to help investors incorporate environmental, social, and governance considerations in their investment processes and investment strategies. So I welcome you to this session. I will let the speakers introduce themselves. We have Colleen Denzler, we have Sam Damore and Rhian Jones, and I will let them explain who they are, what they do, what their role is. After that, we will move on to presentations. We will then have roundtable discussions and an opportunity for you to relay some of your comments and suggestions back to us. So let's start with the introductions. Let's start with Sam.
Hi, I'm Sam Damore. I'm from Trillium Asset Management. I'm a portfolio manager there on our listed US large cap core strategy in addition to our global equity strategy. I've been at Trillium for about a year, but have spent 2 decades in asset management, weaving through sustainability across that entire experience. Trillium, for those unfamiliar, has been solely focused on sustainable, responsible investing since our founding in 1982. We actually co-founded Sayles and US SIF, and we're the 4th signatory from an asset management perspective to PRI. So thank you so much for the invitation to speak here, and I'm really happy to share our thoughts on how we approach the world with you all this morning.
Rhian?
Great. If I'm yelling at anyone, just let me know. We were told to talk normally into the mic. Rhian Jones, head of sustainability at Ownership Capital. We're a boutique investment management firm actually based in Amsterdam in the Netherlands. We have just a single investment strategy in one portfolio, so it's a very simple business model from that perspective. And we work with pension funds, endowments, foundations, focused really on integration of ESG, but also active ownership practices. So looking forward to speaking with everyone today.
Colleen, thank you.
Hi, I'm Colleen. Ooh, that was too much. How about that? I'm Colleen Denzler. I'm Chief Sustainability Officer at Loomis Sayles. We're a $350+ billion asset manager in the US. We have both fixed income and equities. My real title is Sustainability Evangelist. I have been doing this since the 80s. And now I know why. I worked with Trillium in 1986. I used to do their cash management back in the day. I was a portfolio manager at Calvert Group. So I guess I'm the wise elder or the old lady on the panel. You decide.
Wise elder.
Oh, thank you.
Thank you very much for those introductions. Before we go into the case study presentations, I just want to get a bit of a sense of who's in the audience today. So it would be great if you could raise your hand if you are not based in the United States or Canada. Okay, thank you very much. And could you think about the following idea? Imagine you're pivoting away from the use of the term ESG into something called sustainability or responsible investing. How many of you have actually worked for organizations that have moved away from the use of the letters ESG into something else, such as sustainability? Could we have show of hands? Okay. And how many of you have ever made a financial forecast model for the purpose of stock or bond valuation? Okay, thank you. And who thinks it's easy to incorporate financially material, environmental, social, and governance factors into investment analysis? Who thinks it's easy? Okay. Who thinks it may be challenging at times, or most of the time, or all the time? I didn't want to commit you to all the time, but no, thanks for that. And who thinks that it may be challenging to judge what the current stock or bond price actually reflects, what the market is pricing in relation to the environmental social factors? So who thinks it's easy to judge whether the market is pricing it in or not. And who thinks it may be hard or challenging to judge whether the market is pricing this in? Thank you very much. Okay, well, this morning exercise seems to be going quite well. So as we move on to additional show of hand questions, just for the next few minutes, feel free to start using your other hand instead of right hand, left hand, or something like that. No, anyway, that's a joke that didn't go quite right. But anyway, let's move on to the case studies. So we're going to hear from Sam for about 8-9 minutes. She will present the investment process, some of the insights from the investment process at Trillium Asset Management, and you will then have an opportunity to use that as a basis for discussion around your experiences with incorporation of relevant ESG factors into your assessment and investment decision making. So I'll ask Sam to present her case study.
Thanks. Okay, great. So just as a little more background, Trillium is a relatively small asset manager. We have about $6 billion under advisement. And just to set the scene for the case study I'm going to present to you all, in terms of what it is that we do at Trillium, what it is we're trying to achieve. We have a number of benchmark-aware products. We're trying to achieve risk-adjusted performance in those listed products in companies that meet our sustainability criteria whilst pushing for positive change at those companies. It's embedded within our DNA to have both a fundamental and a sustainability-led thesis for companies, and we're quite happy to not own companies for sustainability criteria, even if that means we're going to lose some performance as a result of it. So we have a dual mandate. When you think about how we're set up, very collaborative perspective in terms of pushing for this better global economy. And I hate almost that we have 4 quadrants here in terms of how the team is organized, because it's really a flow of information across all of these various teams to create a mosaic of information in terms of how we think about things. But I really wanted to highlight this slide in terms of the makeup of our firm is a little bit different than most traditional asset managers. We advocate for diversity at the firms we invest in, but we ourselves are quite diverse. And you'll look at those little pie charts at the top, and I think they speak loud and clear in terms of how we might look a little bit different than some of our peers in the industry. This is a traditional slide and funnel slide that you will see at asset managers. This is our version of it in terms of how we go through stocks to get to this case study I'm going to look at today. We have a wide universe of listed equities that we can potentially invest in. How do we screen that down to a portfolio of companies that we're looking at that people can then invest in? So first would be over on the left-hand side in terms of idea generation. A lot of this is quantitative screening, both from a fundamental perspective. We're really looking for those quality companies that have stability and durability in their financials, both historically, but I think more importantly, moving forward. And then from a sustainability perspective, the first lens is really to screen out companies that don't meet our criteria. So first of all, we do have negative screens, which for us is a risk and opportunities perspective in terms of not investing in businesses that we don't believe will succeed over the long term. Some examples would be we screen out companies involved in the tobacco, involved in weapons, gaming, companies that we don't believe will succeed in a low carbon economy. And then the final piece of screening out would be companies that are highly involved in controversy. So we will use MSCI for that. Any company that scores a 0 on the MSCI controversy screen over the last 3 years, we won't invest in. Interestingly, those negative screens only screen out about 10% of the investable universe. From that, we have our whole team that I just showed you on the prior slide doing a lot of bottom-up research to think about what companies might be interesting to move forward into this next quadrant in terms of that integrated approach to financial fundamentals and sustainability. We tend to have a quality bias in companies that we're looking at in terms of quality compounders, and we'll see that writ large through financial statements, be it slightly higher growth, slightly higher return metrics, be it ROIC, ROE. There are many different ways to cut this. And then that sustainability lens, which I'll walk through a bit more in the following slide. But pretty thorough benchmarking process to figure out where companies stand on a lot of this non-financial data, and then digging in to see what are the really material aspects that can move a company moving forward. From that, our analysts will put forward companies that they propose we could buy. We actually have a central approved list at Trillium, so companies that meet both this fundamental and the sustainability criteria will have a centralized vote, which includes all portfolio managers or research analysts. A majority vote wins. If it is on our approved list, then it's something that a portfolio can put into their holdings, which then is a decision made at the portfolio management level. And the final piece, which I think is our real true differentiator, and I'll highlight my colleague sat at the front here, Lisa Hales, who's part of our advocacy department. We have an amazing set of six-person team that is solely focused on pushing for positive change at these companies. We'll look at different priorities every year in terms of where we can move the needle in terms of creating a better, sustainable environment moving forward. And so they do a whole bunch of wonderful work to progress the agenda here. So moving on in terms of this, taking it back to the sustainability piece, how do we do what we do? So the first thing is materiality. And yesterday there was a lot of discussions around different frameworks for this. We have our own internal framework in terms of figuring out what is material here. I think what's interesting is we take inputs from everybody at the firm, be it Lisa and the advocacy team, our research analysts, portfolio managers, to really figure out what are those key performance indicators that matter at the sub-industry level. We have 60 different frameworks across the entire GICS universe to measure what we believe is material from the data. And we'll use all the data, and I love that there's more data. The problem, as you all in the room know, is that it's still patchy, inconsistent, problematic. But we will use third-party resources from MSCI to ISS, and it's really those key indicators from these third-party resources, clearly company-led data, NGOs, nonprofits, and then that incumbent information that we have from having done this for 40 plus years, that all gets screened through into a benchmarking process for us to figure out how these companies are ranking on this key raw data. On the left-hand side of this chart, you'll see a representation of that data aggregated up into these E, S, and G buckets for ease of presentation. I'm really just showing this to highlight the weightings of this differ vastly across all of these different sub-industries. And that is where we believe some of the competitive edge comes in terms of how we look at these companies. This is really the first point for us. It's that industry benchmarking. From there, we can dig into that data. Why is a company scoring in the top quartile or conversely in the bottom quartile? What are the key drivers? Is something wrong with this data? How do we pass this through to figure out, one, where they've been historically, but two, where are they skating toward? So the case study, getting down to how we do what we do. I wanted to describe to you today a somewhat hypothetical process. Our compliance department was having a little bit of trouble in terms of what I was and was not able to present to you. So you'll see company names refed out here, but it's basically two companies, one on the left-hand side in terms of the consumer discretionary space, a large cap consumer company, and I don't know how to get rid of that. Thank you. And another also within the same space. Interestingly, the company on the left-hand side made it to our approved list, and the company on the right-hand side has never made it to our approved list. Not to say that that can't change moving forward. There's a whole bunch of text here that you will not be able to read. But interestingly, through that benchmarking process I just showed you on the prior slide, the company on the left scored close to the 70th percentile, 100th percentile being the best, 0 being the worst. And the company over on the right scored in the 29th percentile. The point here is not those percentiles, but again, when you dig into those key data, what is it that's causing those companies to be so different yet in the same industry? So stepping down into the bottom half of this slide, you'll see a representation of some of those key performance indicators we'll look at and the various weights in the blue bar chart to the left. And then on the right, I've just chosen to highlight some of the key issues that we pulled out from looking at this industry. So firstly, as it pertains to supply chain management, it's important to us that companies are considering the environmental impact of their supply chain, how they choose to treat their employees through the supply chain, even though they're not necessarily direct employees. Do they have best practices in place? Is there any resistance to putting those best practices into place? When thinking about packaging, I'm sure a lot of you have maybe received packages to your home, and we've seen the evolution of how that packaging changes over time, but how is the company working to reduce that level of packaging? We've seen the evolution of SIOC, or ship in own container, in addition to shrinkage of boxes and the use of recycled material. And then lastly, one of the other big things would be labor management in terms of how they are treating their own employees. Are they full-time employees? Are they part-time employees? Are they respecting the right to unionize? Are there wrongful terminations? So we'll pass kind of all this data to sort of look through and see how these companies are scoring it and why, and is there avenue to change, again, with our wonderful advocacy colleagues here at the front. So the company on the left did end up making it to our approved list. Why? I've highlighted a number of key issues here, so we'll walk through. From the supply chain perspective, this particular company encourages suppliers with better environmental impacts throughout their supply chain. Interestingly, they are involved in e-commerce. They have a whole dedicated marketplace dedicated to sustainable products. And as of today, they have about 1 million different SKUs within that specific marketplace. They also have transparency in reporting and fraud detection. Companies will make mistakes. I expect them to make mistakes, but I want to know when they've made mistakes. I want to know what they're doing to address those mistakes. From a packaging perspective, this particular company has 80% of boxes that already have 50% of recycled material. And I think importantly to us, that recycled material and the original material is all Forest Stewardship certified, which is a third-party verification on where that wood is originally coming from. And for us, it's the highest third-party labeling that we have found useful within looking at this framework. And then back to the SIOC, or ship in own container process I walked through earlier, 15% of products are already being shipped in that. So we're shrinking the amount of material that is winding up at your door. From a logistics perspective, very interesting that this company actually doesn't own any of the last mile delivery to the home. However, they have chosen to report the emissions from those third-party owned delivery vehicles in Scope 1. Normally, in traditional reporting materials, you would see that in Scope 3. What does that indicate to us? It indicates a dedication and commitment to the sustainability goals that they put out, instead of the greenwashing or green hushing that we've been talking about in the industry over the last number of years. So that's a qualitative measure on the quantitative data that they are choosing to provide to us. And lastly, and I think this is really the differentiating factor relative to the company that did not make it to our approved list, was labor management. This company actually is mostly full-time employees. 93% of employees are full-time, and 50% of them are unionized. This company has hardly any controversies, which is very, very unusual, and speaks and lends to us the credibility of how they're choosing to treat their employees. So that leads to the creation of a sustainability thesis that then goes to our investment committee with an up, down, yes, no vote, which is a challenge process for us in terms of being able to constructively criticize any thesis that anybody has. And once it makes it to our approved list, we will then have continuous monitoring to make sure that they're continuing to do all these things and doing better and figuring out where we can improve. And that is the end of my case study.
Great, thank you very much for that. We will have a broader Q&A session at a later stage today. But at this point, I would like you to reflect on what you've heard and what you've seen. And I would like you to go into table discussions for the next about 8 minutes to discuss how what you've seen relates to your investment approaches in your firms. What sort of challenges do you have to overcome if you were to try to apply some of these some of these materiality assessment or forecasting or even valuation processes. So please use the next 10 minutes to exchange ideas and discuss various elements of investment analysis. And it would be great if at each table, one of you could go into the conference app and go into the relevant polls. This is, room 718B, and I'll remind you of that at a later stage. If you go into room 718 Q&A polls, and if you could just type in some of these brief observations. Yeah, so we're looking for each table to discuss the investment process, challenges, pros, observations, comments, and it'd be great if one of you at each table could type in a short set of observations into the poll that's going to be available within the app. I will repeat that and remind you of that, but let's go into the table discussions now. Thank you very much for that. We will have another table discussion later on during this session. So we will now display some of the observations, and we will let our panelists respond to the observations that are coming from tables for a few minutes. Okay, Rhian, would you like to just well, first of all, explain maybe your company's investment process,
Sure.
And then reflect on what we are seeing from the audience.
Yeah, so to give a bit of context to some of my comments, we have, as I mentioned, just a single investment portfolio, and it's very concentrated as well. So we typically own 20 to 30 mid to large cap public equities. The universe is global, so similar to the presentation on planet Earth, as Sam's slide showed. But really, our focus when we were launching the strategy was trying to think about how to create an investment process that would align with the long-term time horizon of the institutional client base we had. We actually launched within an asset owner in a pension fund and later spun out. So the intent of the strategy was to try to match those long-term liabilities of the pension fund. So our valuation approach was also centered around that long-term thinking, and we actually use a 10-year discounted cash flow model as the core valuation tool. We feel that time horizon, a lot of people kind of ask, that sounds crazy to use a 10-year DCF, how do you get any sense of precision? But it's the right time horizon for us where we actually really get to see the financial materiality of some of these medium and long-term ESG issues, sustainability issues come into the valuation as well. So that's a little bit of the way that we think about the model, the valuation approach. Similar to the presentation, we also have our own tool for ESG analysis, so where we're trying to really get to that question of which of these factors are material, and in a similar lens, we're starting with the same parameters for every type of company, but then we have the analyst who's responsible for that individual company. They are responsible for making the adjustments of the weightings to those different factors based on what they consider to be material for that individual business. And so we do use as a guidance some of the SASB materiality mapping at the sub-industry level, but we actually ask that analyst to also consider things like the size of the company, the region in which it's operating, other factors that might influence that materiality beyond industry too. And the feeling is that having one person responsible for that, for the financial valuation, and also for the engagement piece, gives them a very good picture of trying to determine which of these factors we think are going to move the needle on the financials of the company. I think we'll get more a little bit into specifically maybe how that comes into the model, but I'll just kind of pause there and compare that to how you guys are doing it.
Thanks for those thoughts. And I would just say thank you for all the questions coming in. I definitely see a common thread here in terms of great, and how are you thinking about this in terms of valuing a company, modeling a company? Yes, 100%. So let me try and address some of that in terms of how we think about it at Trillium. First of all, our analysts are all responsible for their own work. I'm a big proponent in process. And the one thing I do know, having done this for 2 decades, is that there are many different processes and no one right way to make money. So analysts will incorporate these factors into their work, into their valuation frameworks as they see fit. I have a lens at a portfolio manager level in terms of helping ask questions, in terms of how to think about this moving forward. The second piece to recognize is we are long on the asset manager. Within our prospectuses, our turnover is targeted between 10 and 40%. I will tell you we generally average around 20. What does that mean? A 5-year holding period on average, which gives us time to advocate for these companies and work with them to improve all things, be it the fundamentals, but also, I think, importantly, from a sustainability perspective. Then taking it up one further layer, at a portfolio level, I have a fourfold process in terms of how I get stocks into a portfolio. One, that fundamental thesis. 2, the sustainability thesis. 3, valuation. And 4, technicals. What is the market telling us that we don't know today? There's no way that we have full information set on what is going on. From a valuation perspective, this gets really tricky. There are multiple ways to look at things. And I'm a big proponent in both absolute and relative valuation, relative to sector, relative to sub-industry, relative to geography, relative to product set, relative to opportunity. How do we consider many different ways to slice the apple, be it multiples, PE, EBITDA, discounted cash flows? We'll definitely take that look to understand what is really discounted in a stock. Some of these factors, when you think about sustainability risks and opportunities, are quite easy to quantify. Let's take the example of PG&E, a California utility that's gone bankrupt, I don't know how many times, due to climate risk, right? Wildfires. We can quantify the CapEx requirements to underground those wires and what that means for financial returns for that company and the systemic risk that potentially lies in having physical assets located in a wildfire zone. So in that context, yes, we can run that through a DCF model, and the answer is quite clear. In other instances, if we look at AI and a company like NVIDIA, how do you actually quantify from a valuation perspective, the fact that the products that they're producing are more efficient, and therefore, yes, we're going to see more energy usage, more water usage, but if we use their chips, their designs, it's going to be less than a competitor's. How does that get incorporated through? And I don't think we found the full answers to that yet. And I want to be fully cognizant of that. Valuation is one element of the investment process, not the driving force. There are many other pieces of information that go into that mosaic.
Great, thank you very much. We're going to continue this discussion after our second case study. So I would like to ask Colleen to explain her and her colleagues' investment process.
Are you trusting me to get to the next slide? That's a very big ask. Thank you. Okay. Hi, everybody. I feel like I know, 50% of the room. I will say this. I have a distinct situation today. My predecessor, who started everything I'm doing, who I've never met before yesterday, is sitting in the front row and works at, wait for it, Trillium. So, okay, guys, please be nice. Please be nice. Okay, does this work? Yeah? Next slide. There we go. And I feel like I'm showing you my baby, right? This is something that has just consumed me for 40 years. And the work that I'm presenting to you in many ways is the culmination of all of that work. And so I was an athlete. When you're an athlete, you always want to be coached. So I'm opening myself and Loomis Sayles up for coaching today. If we don't have time to talk about your particular question, find me and find Justin Dutcher, the Associate Director, and we're happy to talk to you about what we've done. So what was asked of me was to give an example in the fixed income space. Loomis has 14 different alpha engines. A little bit over half of them are fixed income, the rest are equity. So other than the philosophy, the comments I'm giving you today are focused on fixed income. So this is our philosophy statement. With 14 alpha engines, it took 9 months to get to that statement. It's really amazing to finally be done. But I can say it in 3 words. Integration, well, 3 phrases. Integration, financial materiality, fiduciary duty. And I'll show you exactly what that means for us. Yeah, this isn't working. So within that philosophy, we have 4 pillars that allow us to actually execute on the philosophy. The first one is research. We do, all of our teams do their own research on the fixed income side, so what I'm about to present to you for the process there, we have a centralized fixed income research team that does the research for all of the portfolio teams on the fixed side. And we believe very, very deeply that, particularly with respect to sustainability, the ability to do your own research, to truly understand what is financially material in fixed income, what's going to move spreads, is the competitive advantage. We talk a lot about risk in ESG. That's why we changed the name of our team to sustainability, because I'm more excited about the opportunities, which I think are many. And keep in mind, our seat at the table is as an investment professional. And so it's incumbent on us, with the third piece of our philosophy, fiduciary duty, to make sure that we're looking for those opportunities for our clients, not just reducing risk. And so you can see that valuation is a very important piece of our, actually how we implement our philosophy. And then there's engagement. I'm going to give you an engagement example today. That talks about the engagement process that we've developed over the last few years at Loomis. And then finally, client focus. This one is really important. We are owned by a French company, Natixis, who is owned by BPCE. So we have very, very sophisticated European clients. We also have a significant business in Asia and Japan. And then the bulk of our assets are in the US. We have red state pension funds who we manage money for. The 2 pages you just saw don't change, whether I'm in Texas, in the US, or Paris. They're exactly the same. And for those of you who might be struggling with how do we deal with this broad array of conversations that we have to have politically, my advice to you is know your seat at the table. And at Loomis Sayles, our seat at the table is as investment professionals. So that's what we do. So let's move on. Just quick, this is my team. I think what's important on this page is that we have 70 credit analysts who Justine and I in particular and Justin work with to create our materiality maps. So let's move on to the next page. Okay, this is my secret sauce. I'm giving it to you. I just told you. Take a picture. I got this actually after talking to a European consultant, fixed income consultant. And she said to me, Colleen, you guys are doing great work, but you're not doing enough when the engagement isn't working. And I want you to lay out exactly how you're doing this. So I thought, okay, I'm not a genius, but I know who my client is. So we came home and we implemented this engagement strategy. So we used to do engagement on the fixed income team on about 250 names. And I felt like, can we really do 250 well? And so we took a step back and said, let's have a really focused list. So we went to the analysts and said, tell us the names where you think engagement will move the needle. Not because it's a top 10 holding, not because it's a CCC by MSCI, but where you think our engagement can make a difference, can improve it. And so we came to our focus list, which is currently 64 names. So we have the focus list, and I'll explain what a score of 3 means. It's 1, 2, and 3, 1 being above average for sustainability, 2 being average, and 3 being below average. So the focus list are all 3s. And then once we've decided yes, well, if it's no, then we tell the portfolio managers, listen, if you're going to buy this, you need to know we can't engage it to tighter spreads. That's just not happening. So you buy at your own risk, so to speak, which was important to me because as a prior portfolio manager, I want to know what my risks are and if my team can give me better information going forward. If it's yes, then we initiate the engagement. Every engagement, and we have a fully developed engagement database which produces individual information as well as team and firm-wide engagement. info, which has been a godsend for reporting, but also it helps the portfolio managers. So you have to have an objective. Why are you engaging? You have to have a target, and you have to have a timeline. Timelines are tough. Everybody just says a year and prays it works out, by the way. So once you have that, then you reevaluate as your time frame comes to the point where you need to check it. So did it work? If it didn't work, why didn't it work? Do we need more time? Are we seeing signs of progress, but we need more time? And then if it didn't work, we have an escalation process that involves my team, the credit team, and can involve the senior executives at the firm. We might reach out and do a collaborative engagement with our partners at Natixis or with partners within the industry. And if none of that works, then the portfolio managers of the 7, 8 different alpha engines have the ability to either divest or hold it. And if they hold it, though, they know that the investment team, the sustainability team, wants them to know there's heightened risk, AKA, we don't think you should hold it, just to put that out there. So let's move on to the example. So this is a chemical manufacturer, and gosh, I hate doing this because I can't tell you who it is, and if you guess, you can't say it out loud, okay? Just keep that to yourself, write it, have it in your brain. And this was one where we weren't getting the proper disclosure. And as kind of entry level as that sounds, especially for a chemical company, you can't do the work if you don't have the disclosure. So we wanted to really know, what are you doing? What are your concrete targets? And that's what we engaged to find out. So if you could go to the next page. This is a summary of our materiality maps. I've taken out our scores for proprietary reasoning, but the materiality map is done at the sector industry level. Justine and I spent 18 months sitting down with every single analyst, updating their materiality maps. We started with SASB. SASB had like 17 things that were material, which I get because their job is to give you the breadth. But if you're worried about financial materiality and valuation, you have to hone in on the 5. 5 is even generous. I think really often there's only 3 or 4 things that move spreads. But we went through and we reevaluated all of that. And you can see where we came out on the environment. It's greenhouse gas emissions, water management, toxic emission, waste, and hazardous materials. And those are the percentages. So 40% of the materiality score is going to be on E, 30% on S, and 45% on governance. This particular board is not very diverse, so you got a high percentage there. So finally, we we could move on. This is what happened. So we wanted to see more disclosure and more care, if you will. And so some of the things that they're doing in response to us and others, that's the other thing. Even if it works, you never can take credit because everyone is coming with a lot of the same suggestions, which is good, by the way. So they're rapidly increasing purchasing renewable energy, developing roadmaps for emission reductions, which is very important, and you'll see why. They're exploring carbon capture and circular economy for plastics. So the outcome of this is, wait for it, we get to keep monitoring them. I mean, that's what happens, right? I wish there was some beautiful story where the skies parted and the company was a wonderful place. That's not how this works, everybody. I know you know that. What happened is we made progress. We got what we needed, and now we're continuing. And that's one piece of advice I would give if you're doing engagements, bite-sized engagements. Ask them to do something they can actually do. That forms a tight relationship. And so the focus for us going forward is we want to see more targets specific to addressing emissions reduction. So that's it.
Great. Well, thank you very much for that. So we have another table discussion, this time slightly shorter than previously, so 8 minutes. And please reflect on what you've heard. share any observations, suggestions, or challenges that you can think about, potential solutions, if that's relevant. And please it would be great if at each table one person could type in very brief, one-line observations into the poll, obviously relating to this breakout room 718B. So let's have that discussion for 8 minutes. We will then reflect on the observations, and we will address any questions, if we have time, in the general Q&A, which is on a separate Slido tab. Okay, thank you very much for that. If you have any observations, comments, feel free to type them in. We also have a few questions in the general Q&A. So there is a question about engagement and its importance of engagement in relation to fixed income securities, especially when the holding period is short. Maybe Colleen could reflect on that.
I would love to. I think about this all the time, and I talk to the analysts about it all the time, because if you think that a credit rating is supposed to last 3 years, then an analyst could easily say, well, sure, that's important, but it's not going to impact me, and I have to produce alpha this year. And so the way I talk about it is, when you think about markets, at least in my experience of them over the last 35 years, it's like market doesn't care, cares. And I truly believe, from a sustainability perspective, we are right here, especially for physical risk. You manage munis, those spreads are going to catch up someday, I swear. I keep telling myself that. It's horrible to wish for the end of the world. But how I've been able to communicate it to them is, if you really gave the factors that are financially material, and there's only 4 or 5 of them, you're already looking at these. You already care about these. Plus, we have portfolios that might rebuy a name over and over again. And so in many cases, the holding period is actually longer. And if you're a fixed income person and thinking about risk, you have to protect our investors against all the risks, even the ones you don't know when they're going to happen. And so engagement does matter, in my opinion.
Okay, thank you very much. So looking at what comments you made in response to the first case study, there were contributions or comments in relation to the extent to which ESG considerations can be reflected in long-term forecasts. There were observations regarding the choice of valuation methods. And maybe a quick question for Rhian would be, to what extent can one ever confidently pick 3, 4, 5 key drivers of value or key ESG issues and try to get any sort of precision in longer-term forecasts with impacts on things like cash flow? Or to what extent can one just really do it the quick way or slightly different way and apply some sort of discount or premium to the target value or tinker with the discount rate? How does one judge what's practical and what makes sense? How do you approach that issue?
Yeah, so I would say our feeling is that there really are not good shortcuts to doing this. That's a reason in the team, for example, for that kind of 20 to 25 names we're owning, we have 11 people within the investment team. So we do have the time to do this kind of modeling. Where we can explicitly get these factors into the valuation model. So for example, through sustainable products, where you can kind of get that into your top line growth, where we see maybe cost savings, that's something that can be put pretty directly into the model. But of course, there's also going to be things that feel a little bit more like sentiment, and it's just hard to get the numbers into your model. And we want to leave space for that to get integrated as well. And so part of the investment thesis that the analyst puts forward to our investment committee does also include explicitly more of a qualitative discussion, where things that just don't seem to get into the model maybe as directly as we would like, but we recognize are important to discuss when we're talking about the thesis of the company, that is formalized in the way that we will approach and vote on the name as well. Another tool that we will use sometimes where we feel that we're not getting it maybe into the line items of the model is to tinker with the discount rate, as you mentioned. But it does take quite a lot to move the needle on the discount rate, at least we find in our model. So where we typically see this coming in more naturally is just modeling directly into the line items of the valuation.
Okay, thank you. We also had a question regarding regional variations and the fact that different parts of the world, different regions require a slightly different approach. I guess it's a topic we could discuss for many hours and days, and we had a very interesting sort of side event this morning with focus on Latin America. But maybe, Colleen, would you like to reflect on that question?
I would love to. To go back to the process that I shared with you, when we did the materiality maps with our analysts, we had, for example, a banking analyst for Latin America and emerging markets and a banking analyst for DM. And the banking analyst for emerging markets said, this is easy, it's 100% governance. And so we realized that the issues in emerging markets really are different. And for us as investors, we have to factor in, okay, governance is 100%. Let's put it to 70 and figure out what else is going to become important and what else could influence valuation. And I think one of the big issues that we're going to face as an industry is moving from E to S, because as the just transition is not so just between DM and EM, and we see emerging market countries saying, we want cement, we need energy, we have a right to have everything you have. I feel like that's where the S issues could get really tricky and become very financially material, and it's something that we're watching.
Okay, thank you very much. We have another question on evaluation of data quality for the sources of data you use. So how do you evaluate data quality for the sources of data you use? Any reflections on how your analysts approach this issue?
I'm happy to take that. So I think the good news is there's more data, but the job is often forest from the trees in terms of figuring out what is material. So I think importantly to us, when we go through our materiality mapping, I would concur actually with Colleen in terms of figuring out those 5, we probably do 5 to 7 key indicators, but it's not 20 to narrow it down. So that for one, but 2, only collating variables to look at, where there is consistency across all of these companies, such that we don't have holes in data, and then looking at confidence intervals for that data. When we have the output analysis, how confident are we in what that data is telling us? So we will scrutinize this data just as you'll scrutinize financial data. It's no different from that lens of figuring out what's rubbish and what's not rubbish. And that takes time and a dedicated team of analysts. And I think that's what all of us in the room here can bring to the equation.
And we have a question which I think is targeted at Sam. It's about the stock approval process. Question is, do PMs or analysts have detail on specifics that went into the approved or not approved decision?
Oh, 100%. So our analysts have to put forward pretty detailed reports and then give a thesis to the whole investment committee. Transparency is critical in my process, in our process at Trillium, in terms of creating trust and authenticity of what we're doing. I'm actually more interested when people have a different opinion at the table, because we will have that constructive dialogue. And even if it's a majority vote, and let's just say hypothetically it's a 51% majority vote, and it winds up on our approved list. By the way, that rarely happens. We tend to be much more aligned. But the point is, having that dialogue will figure out and have a better understanding of the risks and opportunities that, me, myself, if I'm going to put that stock that was slightly controversial into a portfolio, I know what risks I'm taking on. Mm-hmm. So yes, it is very clear to everybody the pluses and minuses, because it isn't black and white. And I think a lot of the questions we're getting today are getting into these gray zones. I don't think there are easy answers. And there's a lot that we don't know. And let's just put that on the table and recognize we don't know what we don't know.
Okay, great. Thank you very much. I'm afraid that's probably all we have time for today. So thank you very much for taking part. If you have any questions for us, PRI, in relation to listed equities, then feel free to reach us on listedequity@unpri.org. Please also respond to any requests to provide feedback on how you found this session. It's in the app. So thank you very much for taking part, and we wish you, pleasant rest of the day, and hopefully many productive and useful breakout and plenary sessions between now and the end of tomorrow. Thank you very much.